Welcome to the Dividend Talk podcast, episode 149. 5 things we wish we knew when we started investing. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJI. You look like you're all partied out, buddy.
Yes, definitely. I had a rough week, let's call it like that. And yeah, I had quite some late evenings with, also some, I guess, some alcohol. I think people, when they listen to us, they start thinking we're alcoholics, but actually, I must confess, I'm just a boring husband. And a good father, investing most of my money. But I do like to have a party from time to time. Makes me feel young. So yeah, that's how it is. And I hope I get a good sleep tomorrow morning.
Plenty of dancing, I heard. So you must be wreck tired.
Yes, but I think this is enough about my private life. Yeah, let's stick to dividends.
Yeah, let's move straight into the news of the week. So we don't want to talk about alcohol anymore on this show. Germany has entered a recession. I don't know if you heard that this week, which is interesting. We've been speaking about recessions for a long time. Obviously, Germany is the largest market in the Eurozone, and they've gone into what's called a technical recession, which is obviously based on the amount of quarters they have of negative growth. But it's strange, like I haven't really seen this impact too much in the markets, but even on the news, somebody posted a screenshot on Twitter the day that it was announced, and everything and anything was trending except for actually Germany in a recession. It's like it just never happened.
Yeah. Well, I think, Germany or maybe the US later, this is the most predicted recession ever, I think. Yeah. So if you look at it, the last decade, it was every time a recession was coming up, and now they finally have one. Sometimes stock markets and the wider economy, they don't go in lockstep with each other, right? It might be already priced in and everything. Of course, technically you mentioned because they probably come out of a really high growth numbers, right? So look, for me, it is kind of part of a pattern at the moment. And by the way, the stock market is not jumping anymore, right? Like it used to do. I don't know. How is it doing, for instance, S&P 500? Is it now flat for the year or something like that? Or a few percent up or a few percent down?
I think it's close to being up again, isn't it?
Yeah. But what I'm trying to say is like also the stock market is trading sideways. So I think there's a lot priced in. I think many people expect recessions everywhere. I think what I saw the other time was also a chart how people are, consuming their savings mostly to stay afloat. So at a certain moment, if the savings are not there anymore and people start to pile up debt, and there I also saw some charts, then it's only normal. We hear about the layoffs and everything in big tech. I don't know how it is with other companies, but let's say like that, for me doing this podcast and also for 3 years, besides COVID, the news has not been so bad consistently, right? So again, I cannot predict these things myself. I really don't know whether the stock market will be higher or lower at the end of the year from now. I do know that my dividend portfolio will be up, so that's most important. But if shit really hits the fan, then I'm prepared. I hope, of course, my job is safe. We'll see it by then. But I'm prepared. I know what to do. And let's just continue to investing my dividends.
Yeah, yeah, I think I agree with you. I think it is already priced in. I think we've been speaking about recessions on this show probably for the whole 3 years that we've been podcasting. Particularly by COVID, we were expecting it. So, as you said, it was expected to happen at some point. So, it probably is already priced in. It'll just be interesting to see now how the rest of the Eurozone actually goes after this.
Yeah.
Does it go in lockstep? I know the UK is doing quite well actually compared to the
Mhm.
rest of Europe, but it's probably going to be an entertaining couple of months, maybe towards the end of the year
Yeah.
as Europe recovers. But as you said, the market could be ahead of us, and if we start to see a recovery in the markets, it might mean that we
Yeah.
might see a recovery down the line as well, and in terms of economies.
I just hope that people don't get scared from this news.
Yeah,
Yeah, we do the Dividend podcast also here to show how we are doing, but I'm totally not freaked out by this. I don't even care. We discuss often a bit of macro news, just because we know it's on people's mind, but and also on ours, of course. But generally, specifically short-term macro news should not really bother to us,
yeah,
specifically not for dividend investors. So I hope that people have feel just as comfortable as we do with this stuff. Yeah,
yeah. But
let's keep investing, guys. Come on.
but we've been speaking about it for a long time: recessions, job losses, market crashes, and all this, and we're starting to see them one by one starting to take off. We haven't seen that
Yeah,
capitulation that we spoke about yet, but
yeah,
we're starting to see it all. Like it's a domino effect, all starting to happen,
yeah,
and then we'll see pretty much like COVID, who sticks to the word and stays the course, and who will disappear
yeah.
into the wilderness. But like you, as you said, have a plan, stick to it, and you should be okay.
Exactly.
If your portfolio goes to zero, we probably have bigger problems to worry about in the world.
Exactly. That's how I also think about it.
So we're moving on. Medtronic, one of a company that you wrote about, I think you know quite well. It's known as an Irish company. They have reported their
Mhm.
earnings this week, quite late compared to some.
Yeah, they have a different calendar as well, right? So this was their full year earnings right now. And let's start with what people might have observed is that the stock price is trading around the 80s again. I was doing that like few months ago. And I was not really buying at that time. I wanted to wait for the full year earnings. And they're just not good. Net income is down as what it was in 2021. So last year they had like 5 billion of net income. This time 3.8 billion approximately. Last year they had a free cash flow of 7.4 billion. This time 6 billion, even less than 2021 when it was 6.25 billion. But then if you look at the free cash flow at the moment, yeah, it is then around now, what is it, 4.5 billion? But they pay dividends to shareholders of 3.6 billion. So we are talking with that about a free cash flow dividend payout ratio of 80%, a free cash flow per share in 23 of 343 per share. So if you do that times 20, which is a healthy valuation, I would say, and actually a rich valuation, this stock should be trading at $69, let's say, ballpark figure. That would mean, without doing a real valuation or something like that, that this is still like 15% overvalued at already a really rich multiple for a non-cash flow and non-earnings growing company over the last few years. And that's a bit worrying, right? And then a payout ratio of 80%, then if you look at it like that, it's no wonder that Medtronic also announced that they are only hiking their dividend by 1.5%. And I think this should be really a lesson for investors, our listeners, because I heard a lot of people like a few months ago also, buy Medtronic in the high 70s. Because if you look backwards, the company had an average dividend rate of over the last few years, what was that, 8 to 10%? Yeah, but they were not growing free cash flow. What they did was actually payout percentage expansion from, let's say, 56% to now 80%. But now they are at 80%. They can't anymore. They have also slowed down significantly their repurchasing of shares compared to last year. So there's not a lot of shareholder return. And, we could be going to the low 70s, maybe high 60s, even for longer. And I don't know, over the next few months, if let's say the stock market would start pricing Medtronic rationally. And it shows that since also the incoming CEO, that this incoming CEO has not been able to turn around the business yet. I do like what I'm seeing from the guy, but I still think this might need 1 to 2 years. There's just a lot of competition. MedTech is not easy. We see it with Johnson & Johnson. We see it now with Medtronic. We have seen it with Philips, but Philips has, of course, also it's a litigation issue. But this market at the moment is not easy, I think, not for the big players. And Medtronic is no stranger to that.
Yeah, we've seen this story play out a few times, haven't we? And think of VFC, AT&T as examples where we've seen companies that have a rich history, a rich dividend growth history that everybody looks back on and thinks, okay, this can go on forever. But we start to see earnings decrease, revenue decrease, free cash flow coming under pressure. And then you have these low token dividend increases of the 1%. And they'll do that for as long as they can, maybe 2, 3, 4, 5 years. And then all of a sudden they have nowhere else to go and they have to cut it. And it's like, it's a big shock. And it feels like, to me, I've always stayed away from Medtronic, but it feels like to me that it's a similar kind of story here. And these 1% increases can't go on forever, particularly if they're not growing. If they're not growing.
So I've been really conservative with averaging into Medtronics. It's just a low position for me. And often people were asking me like this and this and this, but for me it was always like in the low 70s. I can add a little bit more because it has been already struggling with its cash flow for 5-6 years. And I think that's really important. And you're right. It might do it small increases first, because that's what dividend growth investing about is. Growth refers also to business strength, to business growth, because when you have that, and companies are able to turn that in a growing profit and growing cash flow, only then you can do sustainable dividend growth. So Medtronic for me right now is, I don't understand all the time when it gets such a rich multiple. Definitely not in a higher interest environment. I don't understand it. And with that, for me, the company is really overvalued still at this price. So maybe someone can explain me why such a high multiple, because if you look at the numbers, it also means that this is not a high quality stock, because if it's not able to grow its business fundamentals, it has great products. It has sticky products. The brand means something. But it's not like Coca-Cola, where you can just hike prices slightly above inflation and such, and therefore still grow your dividends. So yeah.
I will throw you on the spot a little bit, because I know you know a little bit more about these. But do they have a catalyst? Is like what's their picture in the next 5 years?
I don't see a strong catalyst. I mean, there's a strategy from the CEO, but I don't. You could argue that all those strategies are trying to, mention catalyst, but let's say it like that. I don't see a significant needle mover. And that's what's needed at such a business. We spoke last week about realty income, how much property they need to purchase to have a meaningful impact to their bottom line. And that's for me like a needle mover. And I don't see it. And it's hard for a company the size of Medtronic.
And that's my main issue as well. And honestly, if I was holding this company, it would definitely be on my short list to sell. I don't know if I would be happy holding it.
So I have it. I'm not intending to sell it. I'm not intending to grow it either. It is fine where it sits. I don't expect a dividend cut or something like that. I just don't have high expectations for the dividend growth. But I'm not a investor that looks at opportunity costs. Like, okay, if I think that Medtronic now will be like growing to 3% in the next 3-4 years, let's sell it because maybe I can get somewhere else a stock at a similar yield that grows a little bit faster. I mean, for me, that is also a little bit of timing the market in there. So,
Yeah, well, I wouldn't agree with that narrative. I would look at it more of business fundamentals are not improving; they are technically worsening. There is no
yeah,
catalyst. Should they, it's not an opportunity cost, or it's not. Maybe there's something better out there.
yeah,
It's this company is not getting any better. It's getting worse. We've seen this happen before, and there's no catalyst. So why should I hold them and hope they turn it around?
yeah,
I think episode 32 we spoke about how to spot a company in decline. That's a long,
yeah,
long time ago we spoke about that,
yeah,
but I just feel like this feels like that kind of company to me.
yeah. Yeah, might be. For me, it's a little bit giving it the benefit of the doubt. I don't want to punish companies too quickly with this. And yeah, let's see where it brings us. Maybe you're right. Let's see. So, having spoken about Medtronics, let's start still quickly discuss some dividend hikes before we go to the main topic of the show. So, the first one is Lowe's company, the biggest competitor of Home Depot, is hiking their dividend by 5%. So, I'm really curious, like how they will do in a recession type environment. But I think these businesses also together with Home Depot are like very, very solid. Next company that is actually a company that we never talk about. I don't know how well you know the company, but GES, ticker symbol GES, hiked their dividend by 33% to 30 cents quarterly per share. And then the third company is LyondellBasell Industries. They hiked their dividend also by 5%. And this is their 13th year of consecutive dividend growth, which is actually quite interesting company and also a high quality company, I would say.
Yeah.
So currently a 5.5% yield there, right?
Yeah. I threw guess in there first of all, because we speak about Louis Vuitton and all these brands, and I didn't know Guess paid a dividend, but I know for Christmas I treated my wife to a pretty expensive Guess kind of purse, and I just found it the correlation quite good. Maybe these brand names that look, there's a market out there, so maybe they're probably a company worth throwing into. So when I see them pop up as a dividend increase, I said I put it in here to stick it on my radar. LyondellBasell, it's a company that I like and I really like to own, but I can never get over the fact that they nearly went bankrupt, or they did go bankrupt and cut their dividend. It obviously is in a cyclical market, and I don't know. I can never get over that. But it's good to see. It's good to see him continuing with their 13 years of dividend growth as well.
Nice. So hey, these hikes keep on coming in. Maybe a little bit less than before, but yeah, I'm so curious regarding the main topic. So shall we get just started?
Yeah.
So
let's do it.
What are the 5 things you wish you knew when you started investing?
Top of the list, investing on a regular basis is not easy. I mean, in paper, everyone says invest the same amount every month, yada, yada, yada. You do your plan at the beginning. I'm going to be financially independent in 10 years, 15 years, 20 years, whatever it is, and you put it on paper. But when it comes to the crunch, it is not as easy as that, particularly as news and emotions and all these other things come into play. For example, we're talking about recessions and market crashes on this show for a long time, which we said earlier. And sometimes it's natural to think, will I hold back? Will I not invest this month? And you can start that, and it's easy get caught up in that. I find myself sometimes having to force myself to come out of that thinking and say, I've made a commitment, and throw that in. I actually wish that I could. I like that about trading 212 is you can set up recurring. You don't have that option on interactive brokers, but It's not as easy as you think. It's easy to write it down, but sticking to a plan for 10, 15, 20 years. I'm only at it now. Well, maybe I'm at it a bit longer than I thought. I'm at about 5, 6 years now. And sometimes it can be a struggle. So certainly over a long time span, it's not as easy as you think to invest every single month like clockwork.
Yeah, and it's funny that you say that, because it's exactly the same thing that I have number one. And I put it actually in the category of timing the market. So I was definitely in the first 2-3 years timing the market, and I'm just checking at my statistics. For instance, in the year 2016, I really didn't add a lot of investments. It's almost a shame what I invested in those years, and I truly remember that 2016, because the stock market felt so rich, yeah. But for instance, even in 2014, when I started, we came just out of the Greek debt crisis, and I felt like many countries will probably collapse, fear mongering a lot, right? And yes, I was really under investing in my portfolio, thinking like, let's pile up some money for when the stock market will go down. And I've just learned that that's just stupid. I should have at that time just buying Johnson Johnson. Yeah. And so what I also learned, those high quality companies, therefore, and that's maybe also a bridge to my second learning, if they're at your entry yield, let's say in my case 2.75%, it's worth often investing in those, because those bring such a consistency that you can continue investing in those. So timing the market for me it's been definitely one of those things I had to learn not to do, which is really not easy still today. It's easy to fall into the trap of thinking like, let's see what June will do if you're in May.
Yeah, but I mean, news is inherently negative anyway, isn't it? How often do you listen to the news and it's all happy and all good? People generally don't listen to that.
Yeah.
It's normally negative. There's always something going on, and I'm learning to over time try and block that out. Obviously, you try and keep some sort of an interest, but try not to let it cloud my judgment. And it's hard. Like you have this thing about the US debt ceiling now that they're talking about, and if that don't go ahead, the market's going to crash. So naturally, this month it's May. Naturally, this month the thought will come across your mind. Okay, maybe I'll just hold that month back and see what happens next month. But
and then the stock market goes up, and then you feel like, let's wait another month until the stock market comes down again. Yeah, because I could have bought at what the price was 2 days ago before the debt ceiling news.
So yes, and you're just letting your emotions take over. So that's why I try to be as mechanical as possible. I try to automate as much as I can and regularly just put the same amount in. Just try and make that commitment to yourself. And stick to it. But man, I hope I'm sitting here in another 14 years and it'll be my 20th anniversary saying that I've stuck to it every single month.
And before we move to the next, let's say, learning, right? What I'm also suffering from, and specifically in the beginning, is that when you ask book recommendations on social media or you read about book recommendations, what do people tell you? Like Dividend, single best investment, or One Up on Wall Street, or Buffett book, or the other dividend relating books. But those classics are often from the 90s or something like that, 80s, 90s, early 2000s, when there was a different time. Interest rates were higher, dividend yields were higher, valuations were lower. There was no zero interest environment. So we get then put in our mind also with that kind of saying like, this is how you value things, like a 15 or 14 multiple. But what we have seen over the last few years, or actually since 2014, 2015, or zero interest, that zero interest actually inflates the stock market. So then is the question, should you not invest at all in an inflated stock market? Or should you just ride the wave knowing that your portfolio might take a hit? So this is for me also leading, and has been leading to me in timing the market, that you never just see proper stocks valued.
Yeah. Yeah, and it's funny you mentioned books and the time period of them, because they're all, as you said, set maybe a decade, 2 decades, 3 decades ago, but also geared towards America. They're not geared towards
Yes.
Europeans, and we are Europeans, and we're reading these things, and some of them are talking about 401ks and all this kind of
Yeah.
stuff that has no relevance to us. So, yeah, it's definitely different times, as you said, and now we're starting to come into more that inflationary period and more
Yeah.
interest rates. So maybe some of these books might become
Start
a
to,
little,
yeah.
they might become a little bit more applicable to us.
Yeah.
But yeah, moving with the times change, and what it was like in the 80s is different to the 90s, is different
Yeah.
to the noughties, and so on. So yeah, good
Yeah.
one.
But that also brings me to my second learning, which is really interrelated to it, is and the sticking to the plan. Once you actually can just, that's the beauty of dividend growth investing. You can calculate your plan. If you know your savings rate, you can realistically calculate your plan. Yeah. But then sticking to the plan is really, really important. So I just mentioned timing the market, but it's not just timing the market. It is also really consistency to make your numbers. Yeah. So in the beginning, I was, for instance, maybe investing a little bit too much in high yield stocks that had no growth or low growth. Or I was investing even sometimes in too low yielders with decent growth, but not high growth. But you don't make your numbers with that according to your plan. So that's why in my screen, I really have this 2.75 really strictly. Yeah, but then there needs to be proper dividend growth behind it. And I'm calculating 6% annually. Now, people that read my annual report see that I am not making this, how you say it, this compounded dividend growth every year. And the reason for that is I have a few companies in my portfolio that are high yielders and low growers, or even no growers, like Omega Healthcare. So that's why I don't make the number, but it's still okay for my plan, because I've got a higher yield portfolio at the moment, and due to that also. But sticking to the plan. And one thing that really helped me, Derek, you mentioned automation. And the automation is not so much like, for me, like investing it in kind of a pie, but the automation for me is like pay yourself first. Once the salary hits to the account, put the money already that you need according to your plan on your brokerage account, and then it's gone. Yeah, you cannot touch it anymore, because you also invested then as quick as possible. And that's been really helping me to stick to my plan. Really, really helpful.
Yeah, it's a good one, because similar to that, my one is set realistic expectations, and it's good you mentioned stick to your plan, make a plan, and you can calculate what you learn, and when you can retire, and so on. But I think you need to be realistic as well. It's easy to sit down in the beginning and think, I'm going to hit a 60% savings rate. And you could be there, you could be married with no kids, for example, or you could have no mortgage at the time, or you can have lots of different scenarios where that might be possible in that moment. But is that possible over the long term? And I remember when I sat down, I thought I would reach financial independence by 10 years. And I don't think it will. I think it'll be closer to 15 years. And even in terms of that plan, you're probably going, okay, if I invest in 5% yielding companies, 6% yielding companies, I'll get there quickly, and so on. So I just think you need to, at the time, as I said, I gave myself too short for time span. I was probably going to go for higher yielding companies. I was probably going to try and save a lot more than what I'm doing. But at the same time, I'm saving pretty much close to 40%. If I go any more than that, I'm taking away from my kids, my wife, and from what they want to do. So I don't want to do that either. So
Yeah.
I think just being realistic, setting a plan is definitely important, but keeping it realistic, I think, is also just
But
as
how do
important.
you know what is realistic when you start investing?
So in terms of, say, what I can save, I generally, at the time I was basing that I would probably save 60%, but I was ignoring stuff like kids activities and so on. So I just reduced that 40%. I know at 40%, my kids can do whatever they want. pretty much. My wife can do whatever I want. I can do whatever I want. I know that is sustainable. If I go above that, I'm taking away from somebody. So once nobody misses anything, and I'd never have to say to my kids, you can't have that because I'm investing it. I know that's sustainable. So at the current rate, I know that is sustainable. But it took me probably a year to figure that out.
Yeah.
I didn't know it right off the bat because I didn't do that activity. And I remember you saying that you tracked everything was it for the first 3 months or was it the year?
Yeah,
I can't
something
remember.
like that. Yeah.
Yeah. And I think that's even before you start investing, I think that's something that's really, really good to do for a short period of time. And then you'll know what's realistic for you to save and not to save.
Yeah. Yeah, and also you can test with it, right? Like I say, if you just transfer that 70% from your account, and you have to live on the other 30%, you will quickly know if you can make ends meet, because otherwise you have a guy knocking your door to, empty your house.
Take your car away and take your house.
Exactly.
So I'll move on to point 3, and I think a lot of new investors, particularly in this day and age, will probably fall into the same trap. We know a lot of investors came on the scene in and around COVID. It became quite popular. Dividend growth investing was actually the in thing at the time before being absolutely hated. But one of the things is probably try and ignore social media as much as possible. I remember T under 30. Remember that was trending for months and months, and look how that is. And I'm going to talk about one of our hoodies. You can't borrow conviction, and I think that is key. It's hard because you're probably a new investor. You're coming onto Twitter. You're coming onto Reddit. You're coming onto Facebook. You probably have dividend something in front of your name, like I do, and you see all these other people who are posting results. So there's some people posting pretty impressive results, you have to say, on Twitter, on YouTube, and on all these social media platforms. You see that they then recommend the company. Sometimes it's only natural for you to think, okay, this guy knows what they're talking about, or girl, this person knows what they're talking about, and you follow them into it. Like Dividend Growth Investor, for example, he's one everyone would just follow no matter what he says. But as we found out, you can't borrow conviction, and if you own the likes of AT&T, say Philips, or even VFC, you're probably paying the price for that now. So I think that's probably one of the biggest things that I learned is ignore Twitter, ignore social media.
So I must confess that it has been always a bit easy for me, but I've been buying. I was following Jason Fieber in the beginning, and I was also buying stocks that he was writing about, but I didn't do my own homework. So when you say you can't borrow conviction, also means do your own homework. Yeah. So I should have more, I said, learned how to be able to do my own homework in the beginning, because everything that someone like Jason Fieber says makes common sense. Yeah, but for instance, I bought Kinder Morgan MLP, and it was like a toll gate system, how it was being sold. So dividends are safe, until there was no oil coming through the pipeline anymore. And then it's not a matter of toll gate. There's just nothing coming through. So then they cut the dividends. And I had no conviction for this stock. And then what do you do?
So you think of those times, and you have the likes of Jason Fieber who were online at a time when not as many people are active online at the moment. There were probably a handful of people. You could probably count them on 2 hands.
It was still a relatively small community compared to now. And on Twitter, there was not such a shite like now.
So now you have younger people coming in that are used to social media, that are following people on TikTok, and they're seeing all these. You can understand why they get swept up in it, and it's similar to your story, just in a different generation. But I think the quickest lesson you will learn is when things go to the pot, when things go downhill, you will see quite well what you understand in your portfolio and what you don't.
But I'm also sure that there are listeners that have stocks in their portfolio that they have because of you and me talking about it. So from the other side, it works that way as well, right? But like we have our lessons, I guess our listeners also deserve their own lessons by copying our mistakes and not maybe having conviction.
Yeah, but to be fair, I think we're quite open and saying do not copy us. Certainly do not do not copy anything I do. I think that is important to say that, because I think you're right. We do speak to a lot of people, and you can get listeners, and when they're talking through their portfolios, sometimes they match what we're thinking or what we've said, and it's I find it quite funny when I hear it back sometimes, but it is quite real too. And I think it is important that everyone does their own homework, because at the end of the day, we're just two guys who look, we want the best for us, because it's our money. We're putting our money into these.
We have skin in the game.
Yeah, but it doesn't mean we're going to be right. I mean, we want to be right, but it doesn't mean we're going to be right. And
that is also maybe then important, what I had to learn, and that's really a learning now that I didn't know yet in the beginning, is the importance of dividend safety. I really underestimated that in the beginning. I was not even aware of it. I mean, you hear sometimes dividend safety, but what does it even mean? Yeah, so to get that understanding was really important. And dividend safety for me is not just the payout ratio. Yeah, because there can be companies with a good payout ratio, but if they have a poor balance sheet, think about the real estate investment trust sector. Yeah. We know that the top quality rates are doing pretty well, but many of those let's say had an 80% payout ratio, or even Castellum. Yeah, they had a 50% payout ratio, Castellum, and then the balance sheet was so. Let's say interest rates shoot up, boom, they're in trouble. Yeah. So it just also shows you that dividend safety is based on the industry risk that the company is dependent on, let's say, and in this case it's like their business model. Secondly, it's then dependent on 3 financial statements. Do they have a proper income, the earnings? Do they have a proper balance sheet? And do they have a healthy cash flow, let's say, that's growing? And that's why it's also really complex to calculate the dividend safety. But guys, dividend safety is not just the payout ratio. The payout ratio is a screener. If it's high, it should already ring bells. But if it's low, it doesn't mean that the bells also shouldn't ring.
Yeah. And I touched on this with Medtronic, and I was this is where I was kind of gearing towards. Are we talking about dividend? How safe is that? How safe is that dividend? And look, I haven't dug deep enough into them to say it is or it isn't. I know you know them more than me, but I agree with you. You have to know the 3 balance sheets, and my learning number 4 was that there are no shortcuts, and you can read all the articles you want on Seeking Alpha. You can read all the articles you want on your blog and my blog. But there is no shortcuts to actually digging into those annual reports and understanding what's in those annual reports. Definitely, one of the first shows we did, it must have been the first 10 shows we did, is how to analyze a balance sheet. And we found that important enough to be one of our first ever shows at the time. So I can't overstate how important that is to understand the balance sheet, and especially in terms of dividends. I think we've mentioned before, but it's kind of counterintuitive, isn't it? As dividend growth investors, dividend should be the last thing we're looking at. We should nearly forget about the dividend and focus on the rest of the company first. And if that's okay, then you look at the dividend. And I think that's probably a good habit to get into.
Hey, and to your point, I'm looking at our dividend stock dashboard that we created, right?
Yeah.
And we did the last time an update on Medtronic on November last year, 2022. We ran the numbers. What do you think the dividend safety score is?
46.
58 and questionable.
Yeah.
Yeah, and the questionable is because of the growth prospects, and also because of the free cash flow growth, the EPS growth, which was not good, and the free cash flow payout ratio. So they had a 5-year dividend growth rate at the time of 9.6% and now 1.5% like the last year. So, but the balance sheet is strong. Yeah, is strong. They have a really healthy debt to equity, but that's why it's questionable. It's because of the growth part and the high payout ratio. So I must say our dashboard and those metrics that we have in there, they continue time over time to do well. Yeah, to do well. Because I always notice when I ignore it or when I try to, you know, justify my reasoning of why it's maybe safer than it is, usually I'm wrong.
Yeah, yeah. I mean, emotions are usually wrong. You can't beat hard facts and what stay on you in the face sometimes.
Yeah.
But yeah, it's interesting. I'm not surprised that it is questionable. To be honest,
Yeah.
I'm surprised that it's that high. But as you said, if the balance sheet is strong, then
Well, if I run the numbers now, it will be probably lower because of the
yeah, of
dip in
course,
earnings now. So it will
yeah,
reflect on that. But that's also another learning for me. So I just mentioned the importance of dividend safety, but my next learning, I put it like, thanks God, something like GAAP, US GAAP exists. So the general accepted accounting principles. Thanks God that they exist because our CEOs of the companies we own, right? And those CEOs are effectively employed by us. They try to continuously cheat on us. Continuously, they are trying to fool us with their other numbers, right? The non-GAAP EPS or basic EPS or core EPS or, you know, what was it? Adjusted EBITDA.
yeah,
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 these kinds of things, they continue to cheat on us. And these are really bad employees to us. So I'm so happy that GAAP exists because GAAP is really strict in those kinds of things. And the numbers don't lie, humans do. That's
yeah.
one of the biggest learnings for me.
Yeah, but some of these humans are laser focused on getting the best results for that company.
Oh yeah. Oh yeah. I
Um,
like the laser focused one.
but yeah, no,
Yeah.
you're 100% right. And every time I see this wrote down, numbers don't lie or gap earnings, I think of IBM, and I always think of that. And
Ah,
and, and the example you gave of it widening over time, and I think that's actually a good point to bring up again is to compare the two. If you see that gap keep getting bigger and bigger and bigger, and these one-off charges that actually reoccur in a different name every year, it's definitely a red flag. Yeah, it's a good one to bring up. But my last one is history is not an indication of the future.
oh,
And I say this because when you start investing in dividend growth stocks, and if you look up how to start investing in dividend growth stocks, you're going to find pretty fast either the dividend king list or the dividend aristocrat list.
yeah.
And you're going to look at the history and they're all going to be above 25 or above 50 years. And you're going to think to yourself, okay, I can just pick one here and I should be safe. And I wouldn't blame you for having that assumption because these guys have paid it for a hell of a long time.
Yeah.
But then you look at someone like VFC, who are a dividend king. They weren't just an aristocrat, they were a dividend king. And look what happened there. So I think it is really, really important that you do not use the bias from history to make the decisions of the future as
Yeah.
well.
Yeah. I, and I think this is really a good one that you bring up because it relates with my last learning as well that I wish I knew when I started investing, and that is value traps. And one of those that I want to call out is stocks or companies that are subject to fraud or under investigation. I think it's so easy to step into in the value trap there. Think about 3M now. You see 3M, $100, I don't know, 5 or 6% yield. You see the dividend history, 50 years of growth, and you think like, you know, they will get over it. But this reasoning, they will get over it. They will manage. Where do we have the conviction from that that's the case?
Yeah. Yeah.
Because fraud, litigation, and crimes like the Monsanto thing as well around cancer, these are really tricky ones. So what I've learned, when there is such a potential value trap, there needs to be something like a court ruling or a settlement from which you can then understand what the impact is. And CEOs putting money aside is not enough, because the first time they do it, they're usually still naive. And we have seen it with Philips and others. Usually the initial, let's say, litigation reservation that they put aside is not enough. Usually still 2, 3, 4, 5 additional will come over time. So for me, value traps are so easy to step into in the beginning, because also when the price drops really quickly after that, people are quickly to buy something there and not really understanding the consequence of what they are doing with that, specifically in the case of fraud, or let's say litigations coming with really high potential impact.
Yeah, litigation is definitely something to keep an eye on, and 3M is the perfect example. I mean, you come along and you're new to investing. Just as an exercise, while you were talking there, I typed into Google there top 5 dividend aristocrats. Okay,
Yeah.
and on this list, and this is on Forbes. This is not a small site. This is a big site.
Yeah.
Okay, it mentions 3M to buy, and the article is dated May 22nd, 2023. So it's not an old article. It has 3M on there, Walgreens has on there, IBM, and VFC. Come on, so what I hope is new investors, like if they're looking, if they're Googling this stuff and they're finding that, they find this list, to see a list of companies, they Google the best ones to look into, and this is the list that they're getting. One of them has cut their dividend. IBM, we could talk about fraud and everything for so long. We have litigation with 3M. So yeah, I mean, I think it goes back to the previous point, and stay away from blogs, stay away from all that. Try and do your own research, because I mean, that's crazy. I actually can't believe I'm reading reading this article now. But if I was new to this, I would look at that list. I would see someone like 3M. They have the highest yield on this list. They have 6%. So they're actually top of this list. They're recommended by Forbes.
Yeah.
I might go, I'll do it. I might read a little bit about them and say litigation, but they got a 51 year history. I'll buy them. They're sitting under $100. So yeah, you can see how people get caught. But I think, as you said, you need to understand what you own, and when it comes to fraud, litigation, and all those nasty stuff, just stay away. It's just it's just heartbreak at the end of the day. That's all it is.
Exactly. And so this kind of also concludes this section of our podcast show, right? We will soon go to listeners' questions. But I also understand now that we raised a lot of questions in people's minds, because we say like, you should read the financial statements and such. Now, what I would really recommend, this is show number 149. Go through the list, start at 1 or something like that, and look at those topic headlines. We have done about how to read a balance sheet. We have done a show on the free cash flow statements. We have spoken about why IBM is a bad investment in our case. So I think there's a lot of educational material in our podcast shows that will help you answer those questions. Yeah, dollar cost averaging, it's all being discussed on the show already. So don't worry, we've got your back. You would need to do a little bit of digging, but maybe in the show notes we can put a few shows as reference that help us connected to the learnings that we did today, so that our listeners also can follow up a little bit more if they are interesting to really get a little bit more insight. Okay, find those learning, but how do I prevent this, what you mentioned, right? And more practical.
Yeah. Nice one. Yeah, I think that's a good way to wrap up. Lots of things that we wish we knew. Look, we don't have a crystal ball. We might sit here in another 5 years and we'll probably have something completely different, because our experiences will be after changing. But definitely interested to hear from the community on Facebook. I'm not as active as I should be on there, but I do read everything. So I would love to hear from everyone. What do you wish you knew before you started investing? And with that, we'll move on to the listeners' questions. And the first one is from Dave, and he's asking us, would you compare the AI hype to the dot-com bubble?
Ooh, that's a really hard question to ask, and why I'm saying it. So the bubble was a stock market bubble, but the technology change was right. In the late 90s, the introduction of the World Wide Web. Look at how we are living today with smartphones and everything. You can't say that, let's say, people in that time were wrong about the potential of personal computing, the web, all these kinds of things, online shopping. It's insane, yeah. However, I think the market went a little bit too much ahead of itself at the time. Yeah, and that's what we see from time to time. So that's what I think is what went wrong at the time. So if you talk about the potential impact of AI to society and how much value it can add to society, honestly, I think we're at that time indeed where we can really start seeing an impact to society. And AI is already there. Think about your Netflix algorithm, yeah? So it exists already. But what happened with the large language models and ChatGPT here as an example, I think now there's a lot of opportunities to start automating. In the last 5-6 years, we've been playing with chatbots and everywhere in the world. Those customer service agents, right, that you're talking with, and they are bloody annoying. But now with ChatGPT and these large language models, I think there is it can move now really from, that you had to change your way of, you were always instructing kind of a chatbot, right? To make sure you get now I think this is really a game changer. I really see it. Now, of course, it can be then a gold rush. Yeah, but I think the gold is there. And if we look at 10 years down the road, we need self-driving cars almost, yeah, and they will be there. Yeah, but I think we might go a little bit ahead of ourselves. So what is important in these situations like this, look at companies that are actually earning money from AI. Yeah, and this is important. Continue looking at the income statements. Don't buy the hype as such. Yeah, you don't want to see revenue growth. I mean, we've seen it in 2021. Revenue growth. We had all these shit stocks that went sky high. And what was it again? This one with the wet ink, DocuSign.
DocuSign, yeah.
Yeah, come on, guys. In the end, how many signatures do you need to set? Do you need to put? Yeah, it was a bloody wet signature business that went like at a multiple, like sky high. So that's what you need to avoid. Yeah, continue looking a little bit at as a rational investor, conservative investor. But for me, that AI is going to make a larger and larger impact to society, no doubt. Do I think it's a little bit in a hype? Well, it's a conversation of the day, so that's probably a good sign that's a hype. But yeah, that's my opinion.
In terms of comparing it to the dot-com bubble, which is more of a stock market hype, I think these are two completely different things. But in terms of AI hype in itself, yes, I definitely think so. There is huge potential there. I think we're only getting started. We're only trying to figure out where we are with it. But what I find crazy is, and I don't know if it's the same in your place, but all the way up to the boardroom, all they're talking about now is AI. Whenever I bring a project, I work closely in automation. The first thing I'm getting asked about is whether or not I'm going to be introducing some sort of AI to this. So yes, I definitely think there is some sort of hype to it, but the technology is there, it's growing, and I think it has an exciting future. So Hobby Investor has asked us about our thoughts on Starbucks with a PE ratio above 30.
Too expensive.
Yeah, 100%. I suppose the question is asked because, and quite rightly, is every time anyone goes past the Starbucks, it is full to the brim. It's the same here in Ireland, in Waterford as well. They're always full. Starbucks seems to be always full, so it's easy to see why you'd ask the question. But
it's a great business, but it's not growing at such a high rate that it justifies a 32 PE. Secondly, their balance sheet is not that strong. So high quality business, definitely. Stock is just a little bit rich for me. I had the opportunity last year to enter a position in the high 60, low 70. Not saying it will be there anytime soon, but $100 at the earnings power that it has is a little bit too much. But if you want to buy it and put it on the shelf for the next 20 years, I think whether you pay a 30 PE or a 20 PE will not matter that much. I look at it more like there are more attractive stocks elsewhere generally.
Cool. Herman has asked us our thoughts on Signify, ticker symbol LIGHT, as a dividend growth stock.
Yeah, Signify, that's really, really, really an interesting one. So maybe for the users that don't know it, Signify is a stock as a spin-off from Philips. Every stock that got spun off by Philips has been doing better than the parent company. They're effectively one of the largest producers in LED lights, in lamps, effectively all the bulbs there. And this company, you know, is going up and down all the time. I mean, up and down, not in the volatility of Bitcoin. Ticker symbol, by the way, is LIGHT, LIGHT. And the yield is very, very decent at the moment. Now, I like the company. I'm considering sometimes to enter a position there. I think it's a boring, stable business. I think the market is very pessimistic about a business like that. But, you know, I don't see why this company will not be able to grow over time. We need lamps. We need to replace them. So if they're able to, you know, increase revenue above inflation and also earnings, then why not? So it is such a stock that is typically underappreciated, and I just have never really pulled the trigger on it. And maybe I should, but if I'm correct, it has a dividend yield of 6% right now. Yeah. It is trading around 25 euros, which is the year low. It is almost going to the 5-year low, which was 18, let's say, or 15 in the depth of COVID. That doesn't count for me, but let's say it has been touching the 20 euros back in 2019. So yeah, the PE ratio of 7. You know, there's something to say for this stock, I tell you.
Yeah, the only problem I would have is that it's easy to replicate their products and what they have. I remember when I started my apprenticeship, electrician, Philips were always the go-to brand before they obviously spun this company off. And I remember these company, they did have some pretty cool automation when automation was only new in terms of their lighting and how they structured it and stuff. But there's lots of different brands out there. We talk of French companies in terms of what they can do as well. I think there's a lot of competition here. I won't be so bullish on them. I think it's easy to replicate, and I'd be worried. I'd be worried to hold them as a long-term investment because of that. But as you said, Philips have a good record of spinning off companies and then doing better than Philips themselves. But that would be my only concern with this type of company.
Yeah.
Davide has asked us our opinion on Johnson & Johnson and AbbVie. Are they getting interesting?
So for me, AbbVie is not interesting, but I'm anchored around the price that I paid for it. Yeah, Johnson & Johnson, yeah, definitely. What is it? 3.08% yield right now.
Yeah, it's $154, I think, in and around that price range.
Yeah. So for me, it's really interesting, and I should buy something again.
Yeah, it's definitely coming into the buy range. AbbVie, if I remember correctly, you did an exercise that must be a year ago now about the safety of all your companies, and AbbVie was quite low on that list, if I remember.
It is one of the lowest dividend safety when it comes to the balance sheet and the credit rating and such. But that's why also you get a higher yield in return, but you may also demand a higher yield in return.
Yeah.
So for me, I would like to see it in the low hundreds.
Yeah.
Then that would be interesting. But Johnson & Johnson now is like, yeah, it's nice. It's nice.
Like if you're comparing the yield, you got a 3.8 with Johnson & Johnson or a 4.3 with AbbVie. I think it's a no-brainer to look at.
Then I go for Johnson & Johnson. If you look at the risk and then strengthening the quality, Johnson & Johnson is a top 10 foundational stock for me.
Yeah.
So I wasn't checking the share prices at all in the last week. Yeah, since we had the last show a little bit. So thank you to the listener for bringing it to my attention.
Someone's going shopping.
That's how it feels like.
Snowblind has asked us our opinion on ticker symbol VHYL ETF.
Yeah, as a comparison to the Schwab dividend ETF, right, as an alternative.
Yeah.
So look, Snowblind, it gives an attractive yield. I believe is it 5% right now? I think something like that. So it gives an attractive yield. That is really nice. But you know, I think last year it gave like $7 or something. Let me check. So in 2021, it gave 7.2 euro or dollar in dividends, right? In 2020, it was 6.7. In 2019, it was 7.6. So what does this tell you? The dividend income is not stable. It goes up and down. Yes, so you cannot count on the dividend being higher next year. Now, it did have a dividend CAGR for 5 years of 6%. When the last time I checked, it was in the end of 2020, so 2022. So this is not the latest and greatest data on the last two dividend payments. So, and then plus the current yield makes it, of course, having a relatively good Chowder rule of 10, because the current yield I see now is 4.1% at a dividend CAGR of 6% at the time. So yeah, there's something to say. It's one of the better ones, but just know the current yield of 4.1%, and maybe it's even higher or lower because I missed the last two dividend pays, but next year it can be 10-20% lower. For me, that's disqualifying for me as an ETF, because I need the same as my dividend stocks. I need growing dividends, and not over 5 years. I need growing dividends each year, or at least flat, but not dropping.
Cool. I have the yield here is 3.92, which is
okay. So I might have paid a little bit less dividend in one of the last two quarters. I need to update this list for me.
Yeah. Okay. Mac has asked us our opinion on Williams Sonoma, ticker symbol WSM. I think we've been asked about this company before. Williams Sonoma are a home furnishing and houseware brand company. I think most people will know them as they own Pottery Barn. I think that's the most popular place people will know. Some of the other brands I'm not overly familiar with. It's not the type of business I would like to own based on what they do. But if you look at the numbers are actually quite decent. You look at their earnings per share over the last 10 years, for example, they were $2.82 in 2013. It is now estimated to be $13.70 this year. It was slightly higher last year, but given the market that they're in, I'm not surprised that it's going to be a drop from this year to last year. Their dividend per share has gone from 124 up as far as 360 over the same time period. So it compounded quite nicely. I think they average at around an 8% dividend growth rate over that time, which is quite surprising. The dividend yield is in just over 3.4, 3.5%. They got a 17-year dividend history. Yeah, it looks okay. The PE ratios is also a little bit attractive. I don't know the industry that well, but they're trading at around 8, which seems quite low. Historically, they seem to be trading around 14, from what I can see. So you could say from a PE perspective, they look attractively priced as well. It's just when you look at it, you think of home furnishings, you think of houseware brands. We spoke earlier. I know they're based in the US, but we spoke Germany are in a recession. You mentioned that people are dipping into their savings. That to me leaves companies like this out in the cold, and that's why I struggle with. But they certainly seem like a well-managed company based on the high-level numbers that I've seen. I haven't dug into their balance sheet or debt. Do they carry any debt or anything like that? But it would be an interesting pick for somebody based on history. But go back to my learnings. History is not an indication of the future. And for me, this company at this moment is probably not going to interest me. If they'd have to go into deep value for me to want to buy this company. And at a 3.2% dividend yield, there's better options out there for me at the moment.
Makes sense. Good. So then maybe the next question is a Canadian stock, BCE, ticker symbol BCE, 20 years of negative retained earnings and growing dividends. How is this possible? Can you have a look?
I don't know how it's possible. Are they taking on a lot of debt? I mean, retained earnings is what's left over after you pay your dividend, your taxes, and all that sort of fun stuff. So I don't know how it's possible. To be honest with you, I didn't think it would be, unless they are leveraging the tits off themselves. But I don't know. What do you think?
Yeah, so I just don't know the company, right?
I think they're a telecom company. I think.
Yeah. So to your point, retained earnings is usually negative as a result of share repurchases. So yeah, because I said, well, it depends on how you look at the balance sheet, but you have there also the position treasury stock as an example. So, but it's in that part. It's part of the equity. So you can have negative equity. Here. But it can also be an accumulation of losses over the years, right? Continuous losses, loss. And here then the question is this because it's, for instance, like kind of like a real estate investment trust where you need to look at funds from operations or something like that, because it's highly capital intensive? I just don't know the business, and I cannot give a normal answer here. So maybe the runner, if you could explain a little bit more. I didn't have time to prepare like that for the show on this one, but we can have then a conversation further on social media if needed.
Yeah, awesome. Yeah, hey, you learn something new every day. I did not know that. So, it's a great question. Thank you for asking that. And that. No, we have a couple more. Jeremy has asked us, what approach would you recommend for a teenager to invest?
Well, you have a teenager. Explain us.
Yeah, and I just get him to look at companies that he knows, that he understands. Don't worry about dividends, not dividends. What companies does he like? And just, I try to get him to do it more consistently. I think the interest was it ebbs and flows. Sometimes he has it, sometimes it doesn't. And I don't force him or push him because I don't want to be pushy on it. He's only started coming to me again this week. With the Gyro app, I think it's after going up in price again, and he's, oh look, Dad, I have this amount. But I definitely don't push it on him. I want him to do it. I want them, and I talk with the podcast a lot just to try and keep their interest in it. But in terms of investment style, I don't be too pushy. They can make every investment could be a mistake at this stage. It does not matter. It's just about going through the process of getting the basic understanding and building that up over time. So when they are adults, they will be in a much better place than I was when I started.
Nice one. And then the last question for you is from Will Ryan, and he recently noticed that as an Irish investor, he doesn't seem to be charged any withholding tax for UK stocks. Is there a catch here?
Yeah, you still have to pay your taxes. So it's not like when you invest in US stocks, you have to pay a withholding tax and then you pay the rest to the revenue. In this instance, you will have to just file that and you pay tax with the revenue. The only thing I will say is that you should be charged some tax. I think the UK have a tax there. What's it called again? I think it's called UK Domestic Tax Credit, if I remember off the top of my head. That's a small percentage of the dividend, but that's not attributable to the dividend. So, for example, if you received €1,000 after conversion in dividend income from a company, you pay, I don't know, let's say you pay domestic tax credit of €100, then you will be taxed at the Irish rate on the net dividend income, which is 900. So that €100 does not actually go into be taken into consideration. So that's something to look at as well.
Yeah. Wow.
I will finish that up, Will, by saying that the revenue.ie site is really, really good. It's actually a fantastic resource, and I recommend checking it out. And if you're really unsure, give them a ring. I've spoke to these guys a few times. Sometimes you'll get someone who's clueless, I won't lie, but if you ring enough times, you will get someone that knows what they're talking about, and they will answer all your questions.
Nice. With those nice words of wisdom, I think it's a nice time to round up the show. Derek, as always, I really enjoyed this one, and it was not an easy show actually, because to talk about and go back, let's say 6-7 years in time, but it was really good for me because there are some things with those things that I wish I would knew when I started investing. It actually triggered me in thinking as well a little bit. So I need to pay a little bit, again, more attention maybe to dividend safety here and there. I also remember my learning from the beginning of the year. I want to invest more in high quality companies. So this Johnson & Johnson is probably one where I can add my next salary to.
Yeah, sounds good. Thanks again to all our listeners for the questions. I was a little bit late asking it. I didn't even get to it on Facebook, so thanks European DGI for asking there, but we do appreciate all the questions. And as I said, I've learned something new today in terms of retained earnings. So we do enjoy the questions. I think I look forward to the questions most of all. Sometimes I wish we prepared a little bit more from, but we like to do them ad hoc because our answers are more authentic that way. And I hope you all have a lovely weekend. We'll see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.